Today on Expedition Retirement, first, what is the difference between active management and passive management? Next, we are throwing a Boston Tea Party when it comes to fighting back against the taxation without representation Uncle Sam is trying to take out of your 401k and IRA dollars. Finally, who are the three stooges of retirement planning and how you can now spot them and fight back before they start draining your retirement accounts? All that and much more coming up on Expedition Retirement.
Welcome to Expedition Retirement with your host, Greg Aler, the attorney and CEO of Golden Reserve, a financial retirement firm whose focus is helping retirees navigate the boulders of getting down retirement mountain safely. Greg is also a popular radio show host. And now it's time for Expedition Retirement.
I am standing on the streets of Bangkok, Thailand, trying to read the signs to find my way back to my hotel. Is this a restaurant or a library? I am so confused. My 2-year-olds are using hand gestures and language that can best be described as primal to direct my attention to something in the other room. By their mutual looks of disgust, I am not getting it right. I am so confused. I bet retirees feel the same way every time they see a shiny stock chart, hear a reference to some index performance, or someone goes on and on about a Monte Carlo financial analysis. It is a jumbled hot pot of jargon not even an experienced and avid reader of finance can navigate on most days. But hey, having no idea what is happening with your life savings, having no idea what is really at risk in the stock market, and having no idea what you are being charged is all part of the plan when it comes to the financial industry. Do people really understand what can happen to a lifetime of work in a bad market? Imagine what would happen if you retired in 1999 and your financial advisor told you to jump into the NASDAQ. Well, in 2000, you lost 39%. And they said, sit tight, it'll come back. Then in 2001, it lost another 21%. They again said, stay the course. Then in 2002, it lost another 31%. At this point, if you retired with $1 million, you would literally only have $332,000 left in your account, losing almost 3/4 of 30 years of work, and probably heading back to work. In 2008, the S&P lost about 37%, the Dow 33%, and the NASDAQ lost another 40%. Or even last year in 2022, the same three indexes lost between 10 and 30% of your dollars. The theme? Well, you're clearly not the only person that doesn't understand the stock market. Nobody does. Nobody can time it either, which is why it is so confusing that the financial industry charges retirees to guess and gamble. There are plenty of options where $0 of your life's work are at risk that can easily accomplish everything you want in retirement. So stop staring at your advisor's shiny graphs or listening to their endless jargon trying to figure it all out. I have an easy answer. They only get paid if your money is in the stock market. That's why it's there. And if you are paying 1% or more, you can rest assured your dollars are probably in the stock market too. You would be better off on the streets of Bangkok riding in a tuk-tuk getting pad thai recommendations from my 2-year-old twins. You can do better. Find someone that knows how to protect versus guess with your life savings, and just as important, find out what you are actually paying them each year to the penny. That's simple. I rest my case.
You've spent your entire life climbing up retirement mountain, saving, investing, filling up those IRAs, and maybe working with a financial advisor. You made it to the top. Finally, your journey is over. But is it? The most dangerous part is just beginning. Getting down retirement mountain without running out of money is the real challenge. No more paychecks, just boulders tumbling towards your life savings. You need a guide, a plan to avoid the biggest nest egg killers: taxes, market risk, fees, and long-term care costs. You need a roadmap. And that's where we come in. At Golden Reserve, we'll build you a personalized roadmap to get you down retirement mountain safely, which includes 4 incredibly important tools. First, the tax map. Our CPA teams build a strategic tax plan, potentially saving you thousands of dollars. Next, get a true look at how much money can go backwards in the market with our market flashlight. Third, our fee filter. Uncover the thousands of dollars in unnecessary fees you may be paying to your advisor or investments each year. Fourth, skyrocketing long-term care costs means you need our long-term care compass. Our team of attorneys can help protect your house and other assets from a nursing home tragedy. So don't risk your retirement. If you want to make sure your life savings are protected and have saved $250,000 or more for retirement, call us in the next 15 minutes and get a personalized roadmap for retirement. Again, for your complimentary roadmap, call us at 513-599-0000 or visit us at any one of our Cincinnati locations, including Kenwood, Covington, and Mason. Again, for those that have saved $250,000 or more for retirement, call us at 513-599-0000 or visit us online at getyourroadmap.com.
We're excited today to have John Forloin, partner at Golden Reserve, to help us answer some questions and work through some segments. So, John, we're going to start off with one of your expertise here. Yeah. Investments Explained is the name of this segment, and I know people are always confused. There's a bunch of terminology, jargon, there's active, passive, stocks, bonds, lions, tigers, oh my.
Lots of confusion.
Can you help break this down a little bit? Could you just walk through some of the basic investment terminology and items out there that may help some of the viewers at home?
Yeah, absolutely. And Greg, I'm going to go out on a little limb here and use an analogy, so just go with me, okay?
I'm ready.
So let's talk about grilling in the backyard. You know, when I first started doing that, I got my Weber grill and I'm grilling hamburgers, and for some reason, Greg, I felt the need to constantly be flipping those burgers. I would flip them all around, and you know, at the end result, it wasn't too pretty. It
was a dry burger, right?
It was a dry burger. It looked all messed up. So as I got better, I started to think, why not just let the grill do what it's supposed to do? Grill the burgers. So I put them down, I get them perfect on one side, maybe give them a flip, get it perfect on the other side, and voila, I got great burgers. So I'm going to use that as an analogy with this idea of actively managed mutual funds versus passively managed exchange traded funds. Okay, so with the active managed mutual fund, what you got is a lot of buying and selling going on within that fund, a lot of burger flipping going on. The idea is to hopefully create more value for the investor. Doesn't always work out that way. Sometimes they're getting it wrong just as much as they're getting it right, Greg. And the worst part is we're paying a high expense for that, okay?
Because someone's got to be flipping. Every flip is a cost.
Every flip is a cost.
I got it.
And at the end of the day, we might not be getting the value out of that work at all. So that brings us to the passively managed exchange traded fund, or ETF. We're just letting the market do what the market does. We're putting the money into a certain part of the market, depending on what kind of ETF we have, and just letting it do what it's going to do. The difference is we're not paying a high fee inside that fund for all that work. We're again just letting the market do what the market's going to do.
And these are relatively new investment types, right? ETFs and index funds haven't been around for 50 years. They're relatively something that the market's just now seeing and starting to understand.
That's right, but they're commonly used now. The difference is we want our retirees to have more money in their pocket and less money going out in expenses that they don't need.
So at the end of the day, if you want a dry, burnt burger, active managed mutual funds that are overpriced and expensive, if you want a cost-effective, juicy burger, ETFs and index funds are things that our users should think of back at home.
And they have those grill lines on them. Greg,
the grill lines. Well, investments are fun and they do matter, but a 5, 10, or 15% return on $0 is still $0. That is why getting your nest egg protected against the 4 largest risks of retirement is the first part of every plan. Our roadmap deliverable includes a market risk and fee breakdown, and it also includes a detailed IRA tax plan and long-term care planning legal strategy. Nobody is talking about what really matters in retirement. Let's start now. For the first 5 callers with more than $250,000 saved for retirement, we will sit down with you, assess your situation, and build your personalized roadmap at no charge. Just call right now, 513-599-0000. That's 513-599-0000, or go online to getyourroadmap.com. Well, this is one of the most popular segments, the Boston Tea Party, because people want to figure out how they can fight back against Uncle Sam taking more of their hard-earned dollars. And today we're going to focus on 401ks and IRAs. Let's start off with that. Let's just break down, what is a 401k? What is an IRA account?
Well, these are investments that retirees have through their working years that have not been taxed yet. So every dollar that you take out of it down the road will be taxable income. So the idea is to build them up without being taxed yet so that you can grow the money quicker while you're still working.
Yeah, these are usually some of the biggest accounts on retirees' balance sheets, and there's a bunch of numbers involved, right? So let's help us break these down. We see a couple of them here and there.
Yeah, so age 59 and a half, this is the age that Uncle Sam says you are allowed to take money out of your IRA without penalty.
Oh, how nice of them. I can have my own money out.
That's right.
Got it. What about 73?
73, this is the required minimum distribution age, or RMD age. It's an age we're all going to face someday where the IRS says you have to start taking money out of your IRA, and if you don't, it's a pretty stiff penalty. So we pay attention to this one, Greg.
So now I have to take money out.
Yes.
All right. Now, required minimum draws, or RMDs, how do those work?
So basically it's a percentage tied to your age that is right around 4%. And every year we have to take it out, and they'll look at what the value was the year before, they'll apply that percentage, and that's the amount that we have to withdraw from the investment.
That feels kind of small, right? You've waited your whole life, you're 73 years old, and they only make you take 4% out?
Yeah, I mean, it almost sounds like we got a generous uncle in Uncle Sam, right?
How generous is he going to be? Maybe we should tune in to figuring out what some of the tax rates are here.
Yeah, so this is an example where we have a couple married filing jointly. The income is $75,000. If they are married filing jointly, they're looking at about a 12% tax rate. But if this couple loses a spouse and they're filing through a single bracket, they're all of a sudden going to jump to 22%.
Now, I've done this show with you a couple times, and I've heard you talk about the widow's penalty. Walk us through what that means again. For those folks at home that haven't heard that, why is that such an important thing to focus on and not miss?
Right. So the widow's penalty, we talk about that a lot. That's a landmine that can occur if we just kick the can so long that we haven't done anything proactive about taxes. Well, what happens is, again, a married couple filing jointly has a nice wide range to file their taxes. And you can see from this example, the average tax rate is around 12%. If you lose a spouse and now they're filing through the much less forgiving single bracket, you can see the results here, Greg, 22%.
Lower tax rates, obviously, when you're retired, you're married, you have lower rates. If someone passes away, all of a sudden the rates double. That is the widow's penalty.
That's right.
All
we
right.
got it.
Now,
Yeah.
What about, when we come to ordinary income for people filing jointly and then they both pass away?
Yeah, we call this one the kiddos penalty. And again, using the same example, mom and dad continue to save money. They keep it pre-tax for as long as they can. And then the kids end up inheriting the money. Well, they don't have as long to let this money stay tax deferred like mom and dad did. They've only got 10 years now. So what happens inevitably, the money comes out on top of their higher income, and now they're realizing a much higher tax rate. We've seen it as high as 35%.
So there's a reason they want you to wait till 73, it looks like, because of the widows and kiddos penalty. The longer you wait, the more chances of you running into both those roadblocks will happen. And it looks like with every roadblock, you're paying a lot more taxes.
That's right, Greg. Let's use this example on the board here. We've got a retired couple, just under $1 million of pre-tax money. We can use our tax plan versus Uncle Sam's tax plan to get the ideal outcome. And you can see in these examples, for the widow's penalty, they're saving almost $40,000 of expense avoided.
Wow.
And for the kiddo's penalty, over $200,000 of expense avoided just by being proactive with taxes and doing it our way versus Uncle Sam's plan.
So flipping it the other way, if they wait till 73 and run into these two penalties, they're going to be paying an extra $40,000 or an extra $200,000.
You got it.
All right.
That's what we're trying to avoid.
If you want to talk about more than just stock picking and investments, like when to take money out of your IRA and how to beat Uncle Sam, how to cut your investment costs in half, how to protect your house from long-term care costs without buying expensive long-term care insurance, or how to make sure you aren't taking on too much unnecessary market risk, then get your roadmap for retirement right now. Our roadmap is built by our internal team of attorneys, CPAs, and financial retirement planners to address the 4 largest risks of retirement. For the first 5 callers with more than $250,000 saved for retirement, we will sit down with you, assess your situation, and build your personalized roadmap at no charge. Just call right now, 513-599-0000. That's 513-599-0000, or go online to getyourroadmap.com. Well, John, today we're going to give the viewers at home a little dessert. For our roadmap and tool spotlight, we're not going to talk about protection. We are going to talk about some fun stuff for a little bit. We're going to talk about investments. And to do that, what I'd like to do is start off by you just breaking down how investments work and maybe a lot of times what are the risks of different investments in the market.
Yeah, so if you look at this chart here, Greg, we've got our risk scale starting with the most risk on the left and complete safety on the right, and everything kind of in between. So obviously on the risk side, we've got stocks, single stocks that can be definitely more risk in the portfolio. And moving towards the right, we're reducing risk by diversification. That's mutual funds, exchange traded funds, and variable annuities. What's interesting is if we go a little further to bonds, a lot of people think bonds, Greg, are completely safe. The reality is bonds are highly sensitive to interest rates, and you can lose money in bonds.
Are interest rates doing some wacky things right now?
I think we've talked about how high they are right now, and you know what? That's exactly what we don't want for bonds, is the high interest rates on bonds that we currently hold, because it makes values go down.
So if you own a bond and interest rates go up, your value decreases, which means it's less liquid, because then you can't sell it unless it's the end of the term.
That's right. And if you're just looking at your statement as a retiree, this is the bottom line. You have less money on your statement, which we don't want that, right?
No, we don't. No, we don't at all.
So going all the way to the right, the complete safety, obviously checking and savings, CDs, basically bank products, but also index and fixed annuities are on that protected scale. So
when you think about 100% protected, that just means no matter what,
right,
my money is never going backwards. My principal is 100% protected. Is that what we're saying? Like when things get to this side, that no matter what happens, the stock market can go up and down, interest rates can go up and down. The value of my assets aren't moving.
Right, and as a retirement planner for our clients, Greg, we want to know that if we're being safe, we want complete safety. We don't want little surprises from the market to change that.
Okay.
Yeah.
Well, I know that some people say, so what's your philosophy? How do you guys view investments? How do you view allocation? So I know that we came up with the golden portfolio system, also known as the GPS.
GPS.
Pretty good, huh?
I love it.
All right. So why don't you break down how we view that for our viewers at home?
Yeah, we like to look at these four main pillars of investing: safety, liquidity, growth, and income. Now, the financial industry will often tell retirees, you can have two of these, but you can't have all four. They'll make you choose.
Yep.
That's right. So at Golden Reserve, we want our retirees, our clients, to enjoy all four of these elements designed into their own portfolio. So the GPS system, Greg, that you mentioned does exactly that.
Okay, and obviously if you could break down, safety is safety, liquidity is liquidity. Kind of explain to me how you deal with income and growth a little bit.
Yeah, right. So from a growth perspective, we certainly do think that there's value with being in the market. The question is, how much do we want to put in the market? We do have inflation to deal with, so growth is a big thing. When we invest our clients in growth, we are really looking at those exchange-traded funds where we're totally in the market without this big, heavy internal fee working against it. That's the growth side.
Yep.
Yep.
And as for the income?
Yeah, the income, that's another big thing. There's all kinds of different income. We have Social Security, there's people that have pensions, there's some people that have rental properties and they're getting routine income. Basically things that are not tied to the market, that are just kicking off income every month. Well, there's also investments that we can do that will also tee up a lifetime guaranteed income that can play into that as well.
I can see why that GPS makes so much sense for so many retirees. Getting our GPS makes your retirement easier to understand and, most importantly, predictable. But before we get to that part of the planning, we need to protect your assets first, which is why our plan is to protect against the four largest risks of retirement first. Our roadmap includes a market and fee breakdown, a detailed IRA tax plan, and long-term care planning legal strategies. Most financial advisors are not talking about what really matters in retirement. Let's talk about protecting your life's work for the next 30 years. Don't delay. It is too important. You need a roadmap for retirement. For the first 5 callers with more than $250,000 saved for retirement, we will sit down with you, assess your situation, and build your personalized roadmap at no charge. Just call right now, 513-599-0000. That's 513-599-0000, or go online to getyourroadmap.com. Well, this is one of our favorite segments, Mythbusters, where we get to fight back against the financial industry and some of the things that they keep touting and shouting. And I think one of the things we all hear a lot of is, hey, the market always ends up giving you 8%, right?
I hear that one.
Over time, don't worry. If it goes up and down, it's always going to get you 8. And I'm not buying it. Are you buying it?
I'm not buying it.
All right, well, let's dive in.
Let's use an example.
Let's use an example. I think there's 3 big problems here, and one of the first one's compounding.
Right, so in this example, Greg, we have $500,000 of a portfolio value. In year 1, heaven forbid, the market's down 22%. Well, that $500,000 would be down to $390,000. Well, let's talk about how to come back. Well, would it be 22% to get us back to $500,000? That's wrong, Greg. It actually is going to take more than 22%. 22% would only get us to $475,800. We're still about $24,000, $25,000 short.
I think in most people's minds, if they're like, I lost 10% last year or 22%, I just got to get 22% the following year and I'm back to even. And what they miss is that, the compounding nature of you have less money growing. So you need more returns just to get back to zero.
That's exactly right. Okay. Let's show them another example here. So I like this one. If, again, using that $500,000, market goes down 35%. If we're going to average 5% to get back, well, you do the math, it would be just 7 years, right?
7 years?
But because of what you just said, we have the same problem again. We're starting with a lower amount of money. It's going to take longer than 7 years to come back. It actually is going to take 9 years at 5% to get back to where we started. You add in inflation, Greg, even 1%, it could be 12 years.
So if you retired in 2000, 2008 or 9, or even 2022, and you lose 25 or 35%, it could take almost 10 years just to get back to even?
Absolutely. Any of those major market events where there's a big loss right up front, you're looking at a lot of work to get back to where you started.
So let's jump into that a little bit. The big loss up front that people seem to discount in the financial industry. What are the big landmines we should be thinking about?
Oh, this slide right here, Greg, these dates are burned into our brains, right? 2000, 2008, 2022. Look at these losses. That would be the dot-com bubble, losing 40% in the market, 08, 09, housing crisis, 50% down in the market. And then even last year, with the Fed raising interest rates, losing 20% in the market.
Those are big numbers. Could you imagine losing half your life savings the first year of retirement? That would be a tragedy.
That would be the tragedy. And unfortunately, retirees can actually face that right out of the gates. Big losses up front.
So the last thing we're talking about is the yo-yo, that sometimes people don't realize that taking money in the market and then taking money out of the market and when to do it.
Yeah, thinking about these points in time, common emotion is to do something corrective right after something bad happens. And that can actually be the worst thing to do. If we were to remove the bounce back after that loss, look at how we're diluting our results. S&P 500, what could have been 8% is now down to 4%. Dow Jones, 6% down to 1.6%. And the NASDAQ, even bigger, 8% down to 1.4%.
So this is numbers that we pulled from 2000 to 2023. So if people do what they do, which is, oh man, I'm nervous, I lost some money, and take money out of the market, and then they lose that bounce back year, the returns are halved or even worse from being in the market. So a lot of these people that were promised the 8% return at the beginning of this Mythbuster segment are really getting maybe 1.6, 1.4, or at most 4% if they pulled out at any point in time over the last 23 years.
That's right. Sometimes what our emotions are telling us to do is the worst thing to do.
But a lot of times that's what everybody does, right? They take their money out afterwards. It's unbelievable.
Yep.
I think it's safe to say that this myth is busted, John.
I call it busted, Greg.
Awesome. Make this simple. See where your financial advisor is gambling with your money. We will run our market flashlight showing exactly how much of your money is at risk in the stock market. And we'll also run a fee filter showing what you are paying your financial advisor to play the ponies with your life savings. Our roadmap not only includes these tools, but also a detailed IRA tax plan and long-term care planning legal strategies. This second opinion will show you if your plan has any cracks. Don't waste this opportunity. Grab our roadmap for retirement now. For the first 5 callers with more than $250,000 saved for retirement, we will sit down with you, assess your situation, and build your personalized roadmap at no charge. Just call right now, 513-599-0000. That's 513-599-0000, or go online to getyourroadmap.com. We wrap up each show with our Roadmap for Retirement Summer, where we break down what it means to actually see, touch, and feel a roadmap that we deliver to each retiree. And before we get started, we have to ask ourselves some questions. If you're at home and asking yourself, hey, am I in retirement or near retirement? Am I unsure if I have the right plan? Do I have the same plan that got me to retirement? Am I concerned about that being the right plan to get me through retirement? Are you wondering, are you paying too much in taxes or fees? These are things that a lot of people are considering. And last but not least, do you have some concerns? Am I going to run out of money? Am I going to make it through retirement safely? If you answered yes to any of these questions, then a roadmap is the right tool to get you started. And when we dig in, what makes the roadmap so unique is that we don't just build it with financial folks focusing on investments or income plans. We work with our team of CPAs, attorneys, and financial, folks. So it's a retirement plan, not just about investments. It encompasses everything you need to get down retirement mountain safely. And when we look at it, folks, it's comprised of four main parts for the four biggest risks of retirement. Things like taxes. How do you take money out of your IRA to beat Uncle Sam? The market flashlight we talked a lot about today. What's at risk? How much could go backwards? What's it mean in real dollars? We also are going to talk about the fee filter. What are you paying your financial advisor? What are you paying for the investments that they sold you? Is it too much? And then long-term care compass. We're going to sit down with our estate planning and elder care law attorneys to see exactly what legal plans, not just financial plans, are out there to help you protect against the largest risk of retirement, which is going into a nursing home that could be over $100,000 a year. Those are real costs, and those things are very scary. When we get those things put together, then we can focus on things like our income tent and our allocation strategy, which is our golden portfolio system that breaks down where we're going to put your money when it comes to your retirement dollars. Now, when we present this to each one of our retirees that's going through the process, it'll give a summary of what's going on. What are your annual expenses and where your plan currently stacks up against the four largest risks of retirement: taxes, market, fees, and long-term care. Should we be concerned? Does it get a red flag? These are the things that we are focused on in your retirement. And not only are we just going to show you where we think it's at, but where it should go. After the retirement, we'll show you the adjustments we would make to make those flags go green. Folks, this is so important to have a new guide and a new path in retirement to help you navigate all the boulders of retirement successfully. If hearing me talk about the roadmap for retirement the last few minutes didn't get you curious or excited about the different tools and services we provide retirees, then no worries. I wish you luck. But if you see how this could really make a difference between you making it through retirement safely versus stumbling down retirement mountain filled with worry and uncertainty, then let me help you get started. You need a Golden Reserve roadmap for retirement. For the first 5 callers with more than $250,000 saved for retirement, we will sit down with you, assess your situation, and build your personalized roadmap at no charge. Just call right now, 513-599-0000. That's 513-599-0000, or go online to getyourroadmap.com.
You've spent your entire life climbing up retirement mountain, saving, investing, filling up those IRAs, and maybe working with a financial advisor. You made it to the top. Finally, your journey is over. But is it? The most dangerous part is just beginning. Getting down retirement mountain without running out of money is the real challenge. No more paychecks, just boulders tumbling towards your life savings. You need a guide, a plan to avoid the biggest nest egg killers: taxes, market risk, fees, and long-term care costs. You need a roadmap. And that's where we come in. At Golden Reserve, we'll build you a personalized roadmap to get you down retirement mountain safely, which includes 4 incredibly important tools. First, the tax map. Our CPA teams build a strategic tax plan, potentially saving you thousands of dollars. Next, get a true look at how much money can go backwards in the market with our market flashlight. Third, our fee filter. Uncover the thousands of dollars in unnecessary fees you may be paying to your advisor or investments each year. Fourth, skyrocketing long-term care costs means you need our long-term care compass. Our team of attorneys can help protect your house and other assets from a nursing home tragedy. So don't risk your retirement. If you want to make sure your life savings are protected and you've saved $250,000 or more for retirement, call us in the next 15 minutes and get a personalized roadmap for retirement. Again, for your complimentary roadmap, call us at 513-599-0000. Or visit us at any one of our Cincinnati locations, including Kenwood, Covington, and Mason. Or visit us online at getyourroadmap.com.